All right, welcome back to another edition of Advanced Accounting. We're going to continue on with Chapter 3, and I'm only really worried about you getting the material from Learning Objective 4. So, Learning Objectives 1, 2, and 3, not really worried about testing you on that. There's plenty of material alone in Learning Objective 4 that you will see, and I've basically modified, made sure the homework and the quiz follow the same suit. So you only have to worry about Learning Objective 4. We're going to talk about consolidated balance sheets, consolidated worksheets in this learning objective. So what are we really talking about here? First and foremost, we have acquired, the parent company has acquired a subsidiary, and we're using the equity method of accounting, which we don't like. Frowny face. Oh, too much work, right? The initial journal entry is fairly simple and straightforward, but you'll see now why I don't like it. It's the subsequent journal entries that we have to worry about and keep track of. But the idea behind here is the the parent company reports an investment in subsidiary, doesn't do a journal entry for each line item when it acquires it. It's basically investment in sub. It's one line item until consolidation, which we'll talk about next. The subsidiary doesn't do anything, basically. The transaction, if you will, is between the parent and the shareholders of the subsidiary. So the shareholders are the ones that put money into the subsidiary stock. So when the parent is acquiring the subsidiary, what they're really doing is paying cash to the shareholders of the subsidiary, and the shareholders are in turn giving the stock certificates to the parent. So the subsidiary is just like, huh, what's going on? They know about it. The subsidiary knows about it, but I'm just saying that there's no journal entry on the subsidiary side. They just continue to go on about their business as they normally do. What does that mean? Well, it means a subsidiary survives. The parent company is going to do its own accounting. The subsidiary will do its own accounting. So basically, if I'm the parent, hey man, you do you and I'll do me. There are some other concerns and issues we have to worry about when we are using the equity method of accounting to account for our subsidiary. Um, if, in fact, it's a subsidiary that exists in, say, a foreign country, we have issues with currencies that we have to take into consideration when we consolidate. We can't just add their cash with our cash. Those are two different currencies. If they use different accounting principles. Hey, we use IFRS and they use GAAP, or vice versa. We have to figure out, hey, who are we going to use? If we are located in the United States, we're using US GAAP. If the subsidiary is located in Ireland, hey, it's okay that they use IFRS, but when we consolidate, we have to convert IFRS financial information into US GAAP. That may not require a lot of journal entries or adjustments that we need to do with, but generally speaking, if you know anything about IFRS, you know that they're primarily principles based. They're not rules based. We have very strict rules in the United States. So if they're somewhat more of a, hey man, this is kind of what we felt like doing, we have to be very careful about just adding over their numbers. We have to look at how they determine their calculations and their valuations. It's possible that the parent and sub have different year ends, fiscal year ends. It's okay for the parent, for instance, to have a 12/31 year end and the subsidiary to have, say, like a February 28th year end. But generally speaking, usually the subsidiary will adjust its year end to whatever the parent's year end is. Microsoft, by the way, most people don't know this, but Microsoft's fiscal year end is June 30th. So any type of subsidiary that Microsoft has or owns, generally speaking, they're going to try to impose that those subsidiaries convert to a 6/30 year-end cutoff date. Now, if we own more than 50% of a subsidiary, we have to consolidate 100% of that subsidiary's balance sheet and their income statement. So we're talking about a must consolidate. And when we're consolidating, essentially what we're doing is saying that we need to report the financial information of the subsidiary with our own financial information. So we're basically saying, hey, whatever the parent's cash balance is, we're going to add it with the subsidiaries straight across, and that's going to get us a new consolidated balance. That's the idea behind what we're doing. We have to do this. We can't just simply say, oh, we're on our own. So what the idea here is, when we consolidate, we're reporting not just the parent, but all of the affiliates, all of our subsidiaries, any type of strong interest we have in another subsidiary. Hey man, guess what? Now we're one big happy family. We don't have to own 100%, but that's what we're going to focus on for these examples. Consolidation procedures. When we do the consolidation, we have strict rules we have to find. We have to remove the effects of any intercompany transactions. So if I sell to the subsidiary, I have to reverse it out. If I make any purchases from my subsidiary, I have to reverse out those transactions. Okay, and we'll talk more about those kind of things in chapter 6. But essentially, if we're one big family, just because, say, for instance, I'm a parent and I give my child money, the overall family net worth hasn't changed. So individually, yeah, I can see my cash balance go down and my child's cash balance go up. But as a family together, the cash hasn't really moved. It's all within the family. So the key here is that we're thinking about consolidation as one big happy-ish family. We want to ensure that the information that we report reflects transactions with outside parties only. So after we get rid of all the intercompany transactions, the only transactions that the parent, consolidated parent, is going to report are transactions with purely outside parties where there's no real ownership or significant influence. So how do we go about consolidating subsidiaries? If we have 5 or 1 or 500, there must be a pretty organized process. There is. It's not too bad. It's just there's a lot to just kind of remember in this process. Essentially, the idea here is we need to look at the subsidiaries. The subsidiary, or the sub, I would say the sub's assets and liabilities remain on its books at its book value. We don't tell them what to do. But the subsidiary's assets and liabilities must be revalued when we bring it on board to our books. We must revalue it to fair value, subtract off any fair value amortization historically, and then combine the assets and liabilities with the parent. And that's, like I showed you before, is essentially the parent plus the subsidiary essentially equals a consolidated balance. That's what we're doing. But when we're looking at bringing this stuff on board, we have to realize we're not just adding straight across their balances. If their plant and equipment has some sort of fair value adjustment up or down, we have to consider that as part of our overall adjustments to their book values. But we don't tell the subsidiary, hey, you need to adjust your assets to fair value because that's how we bought you. No, subsidiary does what it does, and we're the ones responsible for doing any fair value adjustments on our end. We're going to use a worksheet to do all this, so don't worry about it right now. Just understand that there's a lot of moving parts, but it's pretty organized when you practice it. When we do increase a parent's investment in subsidiary when we do the above process, the parent's investment in subsidiary balance is eliminated. So yeah, remember we have that investment in sub, right, balance in there. The process by which we do our consolidation journal entries is we're essentially taking all of that balance away because we want to report no balances. When I say we're going to do these elimination journal entries, understand that these are top-side journal entries. We don't actually record them. We just do some worksheet Excel journal entries that help us keep track of how we get essentially our balance in the investment in the sub down to 0. That's what we want. But really behind the scenes, what you see is you still have the investment balance. There's no real effect in our general ledger. These are top-side journal entries meant to essentially put whiteout over whatever our accounting system is spitting out, and then we're going through and making these top-side adjustments to sort of white out what is reported and show what really needs to be in place. So we're not manipulating our financial accounting reporting system. We're just changing or modifying, adjusting what we report in between the accounting system and the ending financial statements. This is where these top-side journal entries come into play. So some things we need before we start doing any type of consolidation. First thing we're going to need is, hey, let's spit out into Excel our own data. Then let's acquire the data, the balance sheet information from the subsidiary, and put it side by side. That's a logical first step. After that, before we just do some straight up, hey, let's just add across, we need to consider any type of elimination entries in between. So parent plus subsidiary plus or minus any elimination journal entries is going to get us a consolidated balance sheet. Okay, that's the idea where we're going. Now remember that when we're looking at the investment in sub, one way to sort of figure out, hey, what are these elimination journal entries that we need to worry about? Hey, well, when you think about what's in the balance in the investment account, right, realize that when we initially bought the subsidiary, there was a net book value of, say, $40 million. There was some fair value adjustments up for technology and plant and equipment, and there was an ultimate goodwill portion. So this 50 million right here is comprised of several different pieces that ultimately we will want to take into account when we're doing our elimination, topside elimination entries. That's why before when I said, hey, the journal entry is pretty simple, right? When we get the journal entry, the investment in the company down, that's simple, but we need to keep track of what that balance is comprised of because elimination entries. It's very, very important that we keep track of that stuff. Now, I know some of you are probably wondering, what does visualized consolidation really mean? I want to sort of take a look at the different parties involved in a consolidation. So initially, if we're Beerbo over here, we've got assets. We know that they equal liabilities plus equity, right? And then we have some sort of subsidiary like Dudmeiser Corporation, right? They have their own assets equals liabilities plus equity. And then you kind of have this separation of ownership and control. These are the shareholders of DMC. Okay, they're the ones who actually put money into the corporation. They're holding DMC stock. Okay, now I'm not really too concerned about what Beerbo has in terms of assets, liabilities, and equity, but let's just say that the DMC has total assets of $80 million, total liabilities of 40, and therefore has $40 million of stockholders' equity. When we buy out DMC, what we're doing is we are reducing our cash for, let's say, $50 million. We're going to reduce cash for $50 million, and in the process, we're going to increase our investment in the subsidiary for $50 million. So it's kind of a wash. There's no real change to our balance sheet. We're just swapping one asset for the other. Does DMC do anything at all? No. They just kind of go about their business like they don't really. They go about their business as usual. They know that something's going on behind the scenes, but it's not with the corporation. It's really with the DMC shareholders. The shareholders are getting cash of 50 million from us, right? And in return, what are they doing? They're getting rid of their investment in DMC. They have stock certificates in DMC. They're getting rid of it for whatever their cost basis was. And hopefully, most likely, probably, they're going to have some sort of gain when when the deal is all done, because they're not going to sell their shares in the subsidiary. They're not going to sell their shares to a major corporation without getting some coin on the side. So at the end of the day, when all is said and done, what's really happened? We sort of dropped this iron curtain between the old shareholders of DMC and DMC itself, because now it's really, hey, we're all family now. Okay, so we look at our overall assets haven't changed, liabilities and equity. Nothing's really, the account balances, individual account balances have changed, but overall we see that basically it's only a change in control. It's a change in control. That's a significant event that needs to be reported to the SEC. But for our purposes, we don't have to worry about what the subsidiary needs to do because they don't have to do anything. Now, once we have done that, the question comes down to this. What do we do during consolidation? Because we have to basically take all this stuff on the DMC side and bring it over. How do we do that? Well, we're going to do this kind of like in a two-step process. If the investment in subsidiary account, if I paid $50 million, let's just say that $50 million I paid was partly for the net book value of DMC. So when I do my consolidation, I need to essentially, from a theoretical standpoint, from a practical standpoint, eliminate all $50 million of my investment account. So let me start doing that. I'm going to reduce my investment account by 40 million here. And over on the DMC side, I'm not going to tell them to record this. I'm just going to overwrite whatever they have for their equity to get rid of it. They decrease their overall equities, stockholders' equity. Or total, they reduce their total equity, TE, total equity. Sorry, not TE, TS. Their total stockholders' equity gets reduced by 40 million. So that eliminates a major part of their balance sheet. The next thing I'm going to do is I have to bring over all the net assets. So what I'm going to do in this case is say, all right, I need to overwrite DMC's total assets. Total assets are going to go down by 80. Their total liabilities are going to go down by 40. That's a net change of 40 in that case. How do we deal with that? It's actually a lot simpler than you think. It's kind of like this. If I get rid of their total assets, I'm essentially just adding it to total assets to my books. And if I get rid of their total liabilities, I'm essentially just putting it with my books, 40. So the net effect here is it's a wash. Their overall net assets go down and my net assets go up. That's what the consolidation worksheet's going to show. Their total equity has gone down, as in my total assets have gone down in this case. So things are kind of working side by side, and trust that there are journal entries that show you all this in detail. The final thing I need to deal with is I still got 10 million in my investment account that I need to get rid of. How do I do that? I'm going to reduce the remaining portion of my investment by the 10 million. And the 10 million that I paid above the book value was really for a fair value adjustment. Fair value adjustment for technology. So increase technology due to fair value for, 5 million. Increase the fair value of my property and equipment by 1 million, and then record goodwill for the remaining portion of 4 million. So essentially what I'm doing here is I'm swapping out this remaining 10 million in the investment account. I'm swapping it out for these other asset account adjustments. That's what's going on. The end effect here is, when all is said and done, we're not showing any total assets, total liabilities, or any type of total stockholders' equity from DMC. All we've really done on our side is show an overall increase in the book value of total assets by 80. We've shown some fair value adjustments, including goodwill. So let's do the fair value adjustments first. 6 million in the fair value adjustments, and then goodwill of another 4. We've shown an increase in our liabilities, 40. Now we're responsible for paying that, right? And overall, what else have we done? We've reduced our investment account by that 15 million. So overall, how have things changed for us in this case? We got the 80, we got the 10, so that's 90 right there. Those are increases up of 90, down by 50. So an overall change, balance sheet gross up of 40 on the asset side, which happens to balance with an overall net increase in liabilities of 40. So the idea behind this consolidation is to say, look, the overall, it's what's called a balance sheet gross up. Assets increase by 40, liabilities increase by 40, and total stockholders' equity, there's no changes at all. There's no change at all. That's what's going on in consolidation. That's the process we're going through. So I think it's helpful to kind of have that as a visual as we're going forward here. It's always helpful to look at an example. So we're going to look at our first example here is a consolidation where there is goodwill. And so over here I have Beerbo's different book values of assets, and then DMC I have various information. Okay, the book values we're not too concerned about. We're going to be recorded. We need to worry about ultimately the fair value when it comes to determining what the goodwill is. But what I've done here is sort of broken out kind of like a series of events. When you look at the book values of DMC, we realize that current assets have to be increased by 500,000. So the fair value of the current assets is really 3 million. However, the long-term fixed assets need to be reduced down to 42 million. So those are your long-term fixed assets. And then you have some intangible assets as well there that have to be bumped up by 2 million. Oh, excuse me, bumped up by 3 million. Long-term debt here, what we're saying is that should not be a credit. That should not be a negative number there. That's my bad. That should just be add. We're going to add another 1 million there. The total liabilities, the fair value of the long-term liabilities, unfortunately has gone up by 40 million due to changes in market conditions. Now, when we sum all this sucker up, what we find is that while the net book value of DMC is 10 million, which is, by the way, just the same as summing up the equity, the total book value of the net assets is 10 million, but we find that there's a reduction to the overall book value of $4 million, getting us to the fair value of net assets of 6 million. Now, that's not too much of a concern. Book values don't necessarily reflect market values. So sometimes we have assets that are too high on a book value perspective based on whatever the market's paying for them. But we acknowledge that, hey, the fair value of the net assets line by line is 6 million. Do we pay 6 million? No, in this case, we made a negotiation deal with the board of directors to pay 100 million. That seems like a lot, but hey, if we really want the company, we're going to pay whatever they tell us to pay, right? That means the plug figure for goodwill must be $94 million. What's the actual journal entry associated with this? It's very simple. We pay cash of 100 million and we debit investment in DMC. Why did we go through all this other worksheet crap up above? Well, because we have to worry about we have to worry about the equity method of accounting, in which case all these other little nuances we dealt with here, we have to worry about them come worksheet consolidation time. It gets a little ugly. So now the book gives you a way of sort of calculating goodwill on its own. However you determine goodwill, whatever method makes sense to you, use it. I know some of the homework requires you to fill out an analysis like this. It's up to you. I'm not too particular. As long as you get the actual goodwill number correct, that's fine by me. When it comes to consolidation time, in this case, assume that we close the deal on 12/31 and we have to close out our books and issue financial statements as of 12/31. So imagine that this acquisition happened on the last hour, on the last day of our reporting period. We're going to, like I said, we need three things. We got Beerbo's book values, we got DMC's right next to it. And as you can kind of see, we're sort of adding straight across. But there's this elimination journal entries. They're not just eliminations. They're called elimination journal entries, but they're more like adjustments. Okay? So we know from up above that our current assets that DMC's current assets needed to be bumped up by 500,000. So that's where the information, the crucial information came from up above. There's the $500,000 in the fair value adjustment. There's the reduction of 6.5. There's the increase of 3. All these fair value adjustments we need to take those into consideration when it comes to doing these elimination journal entries, because we know that, hey, these are just book values, man. They need to go up or down based on what we determine what the fair values were. So yeah, we're adding all the way across, but we have to take a stop and say, does DMC need to go up or down with these balances? And then what we do is we account for those balances, add everything straight across, boom, to get us the consolidated balance. That's the process. That's what the worksheet does. Now, sometimes you see in your books where they go through the journal entry first. I like the worksheet first because that helps me figure out, hey, where does everything need to go? If I kind of know that I've got all these adjustments that increase or decrease DMC's balances, book value balances, I'll plug them in here. But there, some tricky parts can come into play where you have to say, what do I do in this spot? Well, let's take a look. Current assets, we did an adjustment for current assets. We need an adjustment to reduce property, plant, and equipment, and we need to increase patents and copyrights, intangibles. Fine. The goodwill we calculated, there's no goodwill right now. Goodwill is going to be inserted. This is a new account line item for us. So we're going to insert this sucker, call it $94 million per up above, what we calculated up above. And then we get down to our investment in DMC. These are all our assets. The investment in DMC is $100 million. We need to make sure it goes to zero by the time we do all our consolidation. So you kind of see here that I have this R journal entry. These R journal entries that we're doing here, those are for revaluations. And we'll talk more about those in a second, but let's keep going further. Current liabilities, we didn't have to adjust those. Long-term debt, we did have to adjust those. Increase with a credit to get it up to the whole $40 million is what we want. So once we do that, the question comes down to this. What's the other part of the R journal entry? Well, down below, I show you that here's all what the worksheet is telling us to do. We need a debit, we need a debit, we need a debit, we need a credit, we need a credit. The plug figure is to our investment account. So we're kind of taking this piecemeal. We're reducing the investment account little by little through these elimination journal entries. So once we adjust all of DMC's net assets, its assets and its liabilities, that will partially take care of, reverse out the investment in the subsidiary. But we're not done yet. Let's go back up to the worksheet. This one is pretty straightforward. I like this. We have these equity account balances in the common stock, APIC, and retained earnings. What do we do with those? We straight up just get rid of them. Because when we consolidate, we only want to show Beerbo's equity accounts. We just want to show these guys. We don't want to add any common stock from another company. It doesn't matter to us. So the E journal entry is pretty simple. So if we go down a little bit to the DMC's E for the equity balances, we are debiting all the credit balances away. Common stock, APIC, retained earnings. Those are all credit balances. We're just straight up getting rid of them. And what's the plug? The plug is to, you guessed it, investment in DMC. And when you do this, you can sort of see 2 credits to the investment account. That gets rid of the full $100 million in the investment in DMC. So this is kind of a cool worksheet. It helps us figure out, hey, how do we get rid of this $100 million through all these different valuation changes? Remember that the $100 million is comprised of a bunch of different things. Up above, we said that the $100 million that we are paying here is comprised of a huge chunk of it goodwill, another chunk of it book value, and then fair value adjustments. So we paid $100 million, which was $94 million above the book value less any fair value adjustments. That whole business that we just did there is essentially what the worksheet is reversing out. All those things that we paid for, we're reversing it out of the investment account to put it in their proper places in the various areas of our financial statement. Once we do that, you know you've done it right if this sucker is zero. Everything else along the way should balance out. So hopefully you kind of see why the equity method of accounting sucks. We have to do that worksheet and those top side elimination journal entries every single time we issue our consolidated financial statements. Moving forward, let's keep that in mind because we're going to build on that though. Okay, let's look at situations where we have goodwill and any previously unreported intangible assets. In this case, it's the same example, but I have these new things, brand names, um, developed technology, etc. We're not worried about some awesome workforce. Okay, it's great you got seniority, but we're not paying for that. Okay, we're still going to pay the $100 million, but we acknowledge that there's these other intangible assets that we need to throw in the mix. So down below, what's really changed? Well, the fair value adjustments have changed. The overall adjustments now are positive. So we're taking the book value 10 million and we're adding another 6.5 million for any fair value adjustments. The overall fair value now of the company has been bumped up from what was it before, 6 million. Now it's at 16.5 million. So we're looking like we're in better shape here. Now down below, what we have to do is keep this consistent. The acquisition price is the same, but we have to adjust. We have to change the goodwill in this case. So over here on the side, I just gave you sort of pointers. Assuming the acquisition price is static, if we do our analysis and we turn out to find some unidentified intangible assets that increases the overall fair value of the net assets of the company, that's going to result in pinching away goodwill. So we kind of see like a fair value, um, any type of increase, adjustment in the fair value of the company is going to pinch away the goodwill. Okay, but that's just how the math works. It's not. There's nothing magical about that. We're just simply saying, hey, we forgot to account for these unidentified intangibles. The 100 million still stands. Let's squeeze out and pinch away goodwill. So down below, the initial investment is still the same. Pretty straightforward. I give you an alternative way to figure out what goodwill is there per the book. The consolidation worksheet looks very, very similar, but what we've added now are three new line items. We still have goodwill, but the goodwill quote unquote elimination or addition journal entry here, they're mostly consolidation journal entries. I don't like how they said elimination entries. We got consolidation entries that create goodwill now of only 83.5 million, not 94 million, 83.5. Why has it gone down? Well, because we have these new accounts that we're taking care of here. So there is nothing on the books of DMC. That's why we have to be very, very careful when we're doing our initial acquisition and really ask ourselves, are we leaving anything out? Because I don't think 94 million in goodwill is really an appropriate number. So once we identify these unidentified tangible assets, we just make sure that they are included as debits, because they're assets in this case, and carried over appropriately. So the worksheet is still the same. Now we have to go through and figure out how the elimination journal entries changed. The simplest one that you can always remember is the E, the elimination of the equity balances. That doesn't change at all. Whatever is over here in DMC, man, get rid of it over here with these elimination journal entries. We only want to carry over our equity, not DMC's. So that journal entry hasn't changed. The revaluation journal entry has changed. We've included these guys and we've shrunk down goodwill, but everything else is still the same in that case. Now, what if we have a situation where there's no goodwill, it's a gain on bargain purchase. There was a bargain purchase. This company is in distress, they need our help, we're coming in, but we're only going to pay them $15 million. Why? Because we're dicks. No, we're not. We're just saying, hey, that seems to be a fair value to pay for the company. The book value is still 10, 6.5, 16.5. That hasn't changed, but the acquisition price has gone way down, which has completely squeezed out our goodwill to the point where, hey, we actually have a gain, man. This is a hell of a deal, right? How's the initial journal entry change? I should say Beerbo, not Ford. We don't care about Ford. Beerbo is what we're talking about here. When we record the investments in DMC, we'll record it at the fair value of the net assets. we initially recorded it at cash. Whenever we paid for it in cash, that's what we recorded previously. But there is a threshold, there's a bottom line where we say, hey, when we buy this thing, we cannot go below the fair value of its net assets. So this, the debit we're going to record is either going to be the cash we paid or the fair value of the net assets. Okay, but we're not going to go below the fair value of the net assets. We can go above it, and that's fine, but not below it. Cash was the $15 million paid, which means we need a plug. This is a plug figure, and we're going to show on our income statement that we have this $1.5 million gain because we found a diamond in the rough. Well, not really. This is just a company that is in desperate need of our help. So we're going to show this on this is going to affect our income statement, and that's fine. How's our worksheet look different? Well, first of all, you'll notice that cash is much higher in this example because we didn't pay as much in cash. And you'll also notice that retained earnings has increased by 1.5 million. Why? Because we had that gain on bargain purchase. That went to our net income. When we closed out the income statement accounts, that goes into our retained earnings. So we see that there's an increase now to our retained earnings account. My apologies for these little parentheses here. They're trying to show these as credit balances, and I hate that. I hate it when they do that stuff. So sorry if you guys were confused by what the heck's going on here. That's just my own sloppy mistake. I should have fixed those. Anyways, so assume those are all just normal credit balances in the equity accounts. What is different about the consolidation worksheet? Well, not too much. One thing for sure is we have no goodwill now. All that is gone. That was squeezed out. We have a gain on bargain purchase. Here's the cool thing about a gain on bargain purchase, though. We don't have to make any type of adjustments to our retained earnings. That gain on bargain purchase, that's real. That's not just some sort of weird phenomenon we have to reverse out. Also keep in mind that the ultimate amount we need to get rid of, the 16.5 million, that still must go to zero. So if we're still confused, or you're still confused about, hey, what are the different balances that go in? I would start by going through all the legitimate asset accounts that DMC has or doesn't show it has, right? And start to plug those in. We know that these asset values haven't changed. Those are still need to be adjusted up or down based on what our consultants say. Same thing with our liabilities. Also, as per usual, we're still going to get rid of the equity accounts. So there's not a whole lot of weirdness going on here. It's just another situation where we say, let's look at the journal entries and change them. The only thing I would really say in this case that's changed is the fact that we don't have any goodwill, so our overall credit to the investment account for the journal entry R is not as high. It was 90 million before, but because we have a gain on bargain purchase, we're only going to credit away 6.5. The equity stuff, that's still the same. So the journal entry for E is the same. The E is slightly different because we don't have goodwill. So those are the main examples, 1, 2, and 3. And I want to skip ahead now to looking at situations where the subsidiary uses push-down accounting. Or it's kind of weird because it really sort of implies that the parent company, Beerbo, is pushing something down. It's kind of negative. It's not really pushed down. It's more like imposed or inserted. This is a situation, pushing down accounting is a situation where the subsidiary acknowledges all those fair value adjustments. Hey, those fair value bumps up and those fair value reductions down. This is where the subsidiary can say, hey, look, let's go ahead and record those. Well, why would the subsidiary actually do that? And is that even legal? Because that would seem to violate historical cost, right? Well, push-down accounting is permitted by the FASB. So when the parent owns a sub, but the sub still wants to issue its own separate financial statements for, say, like debt covenant reasons, it can go ahead and revalue its assets to the fair value that we acknowledge when we bought them based on ASC 805. That's a regulation. It seems like this is a deviation from historical cost, but realize that changes in control are justification for such deviations. This is a major change. The entire ownership of DMC is now in the hands of another corporation, right? That's a major change in control. So what does this subsidiary do? It adjusts all the book values to reflect the acquisition cost, the fair value. It's kind of nice because it helps us It helps Beerbo cut down on all the BS when it does all the consolidation journal entries. So what does this thing look like? Well, let's kind of go back and revisit what we saw before in example number 2. We paid $100 million. There was some unidentified assets, and let's take a look and see how things change. So down below, I'm simply saying that a push-down accounting ignores Beerbo. It basically says, hey, Beerbo, give me that consolidation worksheet because I'm actually going to record some adjustments to my fair values for the sake of issuing my own financial statements. So Beerbo says, here's the consolidation worksheet, and DMC gets rid of all the balances from Beerbo and says, let's just show what our book values are, and let's go through and let's just add, subtract, add, right? Increase that. And wait a minute, do we want to get rid of our retained earnings? Yes, we do. In fact, this is where it gets kind of strange because the idea about push down accounting, as it says up above, is it gives a chance for the subsidiary to start from scratch. So it's almost like it's setting the subsidiary's clock back to zero. Retained earnings and any AOCI are eliminated. That's part of this process. It's almost as if the sub paid with its retained earnings for fair value adjustments to its assets and liabilities. It's kind of like that. Okay, that's what's going on, but it's not a perfect situation. There's always some sort of residual left over. So down below, here's how you do it. You go through and you make all your adjustments as we've seen before to the assets and the liabilities. You also get rid of the retained earnings, okay, because we're resetting the clock back to zero for the subsidiary. When that happens, you're going to need another plug amount, and this is going to create a new account called pushdown capital. And don't worry, anybody who looks at the subsidiary's financial statements is going to know what that means. This DMC is wholly owned by Beerbo. There is only one investor. The only reason why DMC would issue its own financial statements is to, hey, give it to Beerbo's auditors or give it to the credit Beerbo's bankers or creditors, right? DMC can issue financial statements, but it doesn't need to. The only reason why DMC would issue financial statements to a shareholder would be if Beerbo asked for financial statements. Beerbo is the only shareholder of DMC. So there's no need for DMC to issue financial statements, but if it does, here's what it can do without any real risk of manipulation. So down below, I'm simply telling you that DMC essentially records a variation of the R elimination journal entry that we saw before. It's not really an elimination, it's a revaluation. So this kind of looks the same. It's somewhat of an R. We go through and we do our increases and decreases. We acknowledge the goodwill. And then we say, or should I say, the DMC acknowledges the goodwill. They're going to record that at their level. Thank you so much. And when they do, they get rid of the retained earnings. There's no investment in DMC. And there's a plug figure for pushdown capital. If they do that, pushdown accounting, we frickin' love them for doing that. Beerbo loves it when the subsidiary does pushdown accounting because this is one less elimination entry on consolidation that we have to worry about. So down below, I can go through this. Huzzah! If DMC provides Beerbo with financial data that incorporates the revaluation entry, then Beerbo no longer needs to record the elimination entry R. Yay, that makes us happy. This is because DMC's revaluation already revalues its assets and liabilities to fair value. Hooray, we really like it when you guys do push down accounting. One less thing for us to do, but we have to realize that there's still the E journal entry we have to deal with. In this case, all we're simply saying is, look, we're still got to get rid of this common stock. We got to get rid of this additional paid-in capital, and we got to get rid of this new push-down capital up above. So all those things you just saw up above, everything's all well and good, except now we're going to have to come through, for our sake and when we do our consolidation, we're going to have a debit to get rid of that 95.9 million. We're still going to get rid of the common stock and additional paid-in capital. But that's all we have to do on our end. Once we do that, we'll get rid of the full $100 million. So we're still going to have like our own consolidation worksheet, but we're going to use all of DMC's numbers in this account column when we do our consolidation worksheet. And it's going to be sweet. It's like one journal entry. Get rid of all the equity accounts. Boom, done. And so we like them for doing that. Having them help us out is always a good thing. So push down accounting is a good thing. Here's an example where there's a gain. I'll let you read that on your own. Gain on bargain purchase, and a few pros and cons about doing push down accounting. That's all I really want to talk about for chapter 3. All the homework and quizzes are just focused on the material that I'm covering in this lecture. So if you have any questions, please let me know.